Good morning. Welcome and thank you everyone for joining us today on the launch of our Brodies Banking and Finance Academy. I hope you're all well. It would be really lovely to have you into the office and welcome you in person and give you a cup of coffee. But until we can do that safely, please accept our very best wishes virtually. So the Brodies Banking and Finance Academy has been set up to provide opportunities for junior banking and finance professionals from graduate to around 5 years experience to improve their on-the-job performance, but also to give them the chance to expand their networks of contacts and build on relationships within the industry. We've got upcoming sessions that will cover the transition away from LIBOR and the UK government funding schemes and also sustainable finance. But today's webinar is about Brexit and how it has impacted banks and finance transactions. So Brexit has often been described as a journey rather than a destination, and we certainly hope you'll get a flavour of that from today's discussion. And today marks 3 months since the UK-EU Trade and Cooperation Agreement, the TCA, was agreed. So it's a good time to take stock of where we are. Kendall's going to look at how Brexit has impacted the way that UK lenders can enforce judgments against debtors in the EU. And Clare is going to look at the changes we're seeing to finance documentation or starting to see and trends in changes to the documents, and also more broadly at how Brexit has affected the market generally. And that's something that each of you will have your own experiences and views on in your own roles, and we'll come to that in just a little minute. So before the technical stuff from Kendall and Clare, I'm just going to do a bit of setting of the scene and looking at the EU-UK Trade and Cooperation Agreement, what it means for UK banks, and to share some thoughts on the awaited Memorandum of Understanding. But before I start, I'm going to bring up our poll, and this is to get your views on Brexit. So this is your experiences and your thoughts on the impact of Brexit on financial services. And we'll look at the outcome of the poll later, but the question is, in your experience, has the effect of Brexit led to decreased, increased, or no change in financial activity? So we're seeing the results coming in there, and we'll touch on where we get to and the final outcome just later in the session with Clare. But it looks like we're still getting results coming in, so that's great. So let's look at the Trade and Cooperation Agreement itself. Always a little bit of a roller coaster ride when we talk about the TCA, because the good news was that at the relative 11th hour, we got the UK-EU Trade and Cooperation Agreement. Agreed on Christmas Eve and incorporated into UK law on New Year's Eve. It's being applied on a provisional basis at the moment because the EU hasn't quite approved and ratified it, but that's just a matter of procedure. So after the good news, the not so good news was that financial services was not really covered in a meaningful way. The TCA is long, it runs to over 1,200 pages, but really only 4 of those are directly relevant to financial services. So if you hear that in relation to financial services, the TCA was effectively a hard Brexit or close to a no-deal Brexit, it's because the TCA is very financial services light. And by the time the TCA was agreed back in December, that didn't come as a surprise to the financial services industry. We'd possibly have hoped for a bit more if we'd rolled back a few months, but by the time it was agreed, it was not a surprise. So what is in the actual TCA? And I think that the key point to take away is the prudential carve-out. Now that allows the Bank of England and the European Central Bank to act independently of one another when they're acting to preserve the financial stability or the integrity of their own financial markets. So they can take action that they consider necessary to protect investors, depositors, and so forth. And there's nothing in the TCA that can cut across that. And that in itself can restrict the trade enabling function of the TCA for financial services quite significantly. There's also the most favoured nation carve-out. Now, a most favoured nation provision would guarantee that if either party were to propose more advantageous, better terms to another state, those terms would also apply to the EU and the UK. So the UK is not going to be able to benefit from a more favourable treatment on financial services that the EU could choose to grant another non-EU country in any future negotiations. And that could impact the future competitiveness and opportunity for growth of UK financial services. International standards. So the UK and the EU have committed to do their best to make sure that they implement and apply internationally agreed standards of regulation and supervision on matters such as the fight against money laundering, anti-terrorist financing, and so on. And then the three pebbles across the bottom on the slide there, if we really distill those down quite significantly, those essentially commit both the UK and the EU to maintain their markets as being open on a non-discriminatory basis to firms in the UK and the EU, provided those have been appropriately established in the relevant country, in the host country. And that really is the TCA for financial services in a nutshell. But the thing with the TCA is that it's not just what is in the TCA that's important, it's what's not there. And the thing that the TCA does not do for UK financial services firms is to give market access rights that in any way comparable to what the UK financial services firms had been used to under the passporting regime. So there's no passporting regime. And while we have the temporary permissions regime for EEA firms that passported into the UK on a temporary basis, there's no reciprocal or mirror arrangement from the EU for UK firms looking to continue to do business with EU clients. As well as no passporting regime, there are no equivalent provisions. The agreement itself does not include any provisions on equivalence frameworks for financial services. And that's because those are unilateral decisions that each party makes independently, and they're not subject to negotiation. And that's a point that the European Commission has made fairly consistently and repeatedly throughout the Brexit journey. And it's clear that the EU Commission at this stage is keeping an eye on how the UK might diverge from the EU frameworks post-Brexit. So that's the TCA, what's in it and what's not in it. Let's look now at the Memorandum of Understanding. So at the time the TCA was agreed, the UK and the EU made a number of joint declarations on a number of different matters, and one of those was financial services. The UK and the EU committed to enter into a Memorandum of Understanding by March 2021, so this month, we're expecting things quite imminently, to establish a framework for regulatory cooperation on financial services. So what can we expect from the MOU? I think the main thing to take away is that it's not going to be a mini trade deal. All those things that we might have liked to have seen in the TCA are not suddenly going to appear in the MOU. It really is much more likely just to be a cooperation framework. So likely to be limited in scope and to contain a commitment to clear obstacles to cross-border UK-EU trade, likely also to have some form of commitment to information share on regulatory plans, just to make it, to stop putting hurdles in the place of financial services firms. And essentially it's going to create a talking shop, a forum which will have probably little impact or constraint on the decision-making of the EU and the UK. So that's what we think is likely to be. What is it not going to have? What's it likely not to have? Well, it's unlikely to include any equivalence decisions for the reason that I've just mentioned. It's also unlikely to create a different type of equivalence regime or framework, although it might provide a bit more information on how the equivalence process might work going forward now that the UK is outside the EU. And finally, it's not going to address UK divergence. And by that, I mean the UK in the MOU is not going to agree to restrain its ability to make its own rules for the UK going forward. The UK on various occasions through speeches, etc., has made it clear that the UK is not going to be a rule taker. So that's the TCA and the Memorandum of Understanding, just kind of as a backdrop to the more detailed and technical points that Clare and Kendall are going to talk you through. And Clare now is going to look more in detail at the changes we are seeing to finance documents themselves.
Thanks, Lindsay. So now we'll move on to having a look at the impact of Brexit on finance documentation. I know that not everyone who's on this session will be responsible for reviewing the detail of finance documents, but hopefully just having a brief look at what changes there may be will be helpful to all of us. So in terms of finance documents, we've obviously got various types of financing transactions, so from project finance to acquisition finance to real estate finance and also general corporate finance. And each of those types of financings will require similar documents, although it will vary depending on the type of transaction and the value of the transaction. But in most of these finance transactions, we will have a loan agreement, which can also be called the facility agreement or a credit agreement, as well as security documents. And for the security documents, those will commonly include some sort of bond and floating charge over all the assets of the company, and perhaps also some fixed security over land. So for example, a legal charge or a standard security. And of course, there are various other types of security documents. On some transactions, you might also come across legal opinions. And legal opinions are basically letters from law firms to lenders giving various confirmations about the transaction. So, for example, about the capacity of a borrower to enter into the finance documents, or about the validity and enforceability of the finance documents themselves. In terms of the impact of Brexit on these documents, the good news is that we don't expect there will be too much of an impact, so it will be pretty smooth sailing at first, at least. The first key thing that will be needed to be updated in finance documents will be any references to EU legislation, to the EU, to the EEA, or to any other member states. In loan agreements, this will need to be considered on a deal-by-deal basis to make sure that any changes reflect the intention of the parties, because there are some variations on what you could agree. In legal opinions, you may notice some updates to a firm's standard template legal opinion. These might be in the legal opinions themselves, which are the confirmations which the law firm gives, or perhaps in the assumptions and qualification sections. Other clauses in loan agreements which may need to be updated are bail-in clauses. These clauses are required to ensure the smooth operation of bank recovery procedures, and those were introduced following the European financial crisis by the European Commission. Article 55 of the Bank Recovery and Resolution Directive requires firms subject to it to include a bail-in clause in agreements governed by the laws of a non-EEA country. So obviously now that will include Scots law and English law. The Loan Market Association has issued an amended LMA bail-in clause, and that's to be included in LMA-based finance documents. So that's a really good thing to look up if you're interested in finding out a bit more about this. And they also have a handy user's guide which goes along with that. And just as a side note, for those of you who might not be familiar with the LMA, the Loan Market Association yet, they basically represent the syndicated loan market in Europe, and they establish commonly accepted market practice, and they also have some very useful templates to use. So even if your transaction isn't expressly LMA based on LMA based documents, you might want to have a look at those to get a good idea of what's happening in other places in the market. So finally, in terms of the impact on the finance documents themselves, jurisdiction clauses are key clauses which will need to be considered. Kendall's going to explain in a bit more detail about what will need to be considered on those in a moment, and talk about the related issue of enforcement of finance documents overseas. But in summary, in respect to the changes required to finance documents as a result of Brexit, our view is these will be quite minimal, but it is still important to look out for them, and they will change on a transaction by transaction basis.
Thanks, Claire. So yes, moving on to my section is to delve a little bit into an overview on enforcement of finance documents in the EU. So I'm going to talk a little bit about the background and touch on things to look out for, including any relevant changes to finance agreements, as Claire mentioned, and we can consider the impact, if any. So the impact of Brexit in this context surrounds where lenders are involved in cross-border agreements with some link to the EU. So this could be where the borrower is in an EU member state, or maybe a borrower's assets are in an EU member state. The other relevant part of this topic is where we continue to choose, whether we continue to choose English law as your governing law of a contract, which I will also touch on. This is a quote just on the next slide that I quite liked, which I think really demonstrates the importance of this topic. And even though hopefully it might not be the thing that you see all too often, it just highlights that the enforcement of contracts are something that really needs proper consideration from us and from me. So onto the background of enforcement. The kind of high-level summary is that there are 3 EU or international regimes that operated in the UK pre-Brexit. So these are on the screen: Brussels Recast Regulation, the Lugano Convention, and the Hague Convention. I'll discuss each of these in turn, but in summary, post-Brexit, we can no longer, at least at the moment, rely on Brussels or Lugano, and we can possibly rely on the Hague Convention, subject to some things to look out for. So the Brussels Recast Regulation is a straightforward procedure for reciprocal enforcement between EU member states, which means a judgment given in one member state is registered and can be enforced in another member state, just as if it was a national judgment. So prior to the end of December, English and Scottish judgments were enforceable in any of the countries on the next slide with relative ease. These are just a list of EU member states. So the Lugano Convention works in a similar way for the EEA and extends to Switzerland, Iceland, and Norway. The UK did submit its application to the Lugano Convention last year. I think it was in April, but all party consent is required for entry, and at the moment the EU's is not forthcoming. So since the 31st of December, we can no longer rely on Brussels or Lugano. So if we do have a UK judgment that we need to enforce in the EU, what are our options? So option 1, recognition and enforcement of UK judgments might be governed by the national law of the state where enforcement is sought. So for this, local advice from the country in which enforcement is sought is always going to be required. However, a common opinion is that the problem is not as significant as it's sometimes made out, and that loss of these 2 conventions won't cause a huge problem. English and Scots law is now in reality in the same position as, for example, New York law has always been. And really the experience has been that courts tend to recognise the judgments of other courts. This is also the case for most European countries. They do tend to support and enforce other countries' judgments. Germany and France have procedures under their own domestic law for the recognition and enforcement of judgments, which are really quite similar to the procedures under the Brussels regulation. So in reality, enforcement should not be too difficult or onerous. But there is a second option, which is the Hague Convention, which is generally claimed to be our next best option, or at least an option. The Hague Convention is the 2005 Hague Convention on Choice of Court Agreements. The UK originally joined as part of the EU on the 1st of October 2015. However, following Brexit, the UK has acceded in its own right, so it does still have force of law in the UK. This convention gives us another chance to enforce judgments cross-border with relative ease. It essentially provides that a judgment given by a UK court will be recognised and enforced in the EU and vice versa. Something to note though is that the Hague does only apply to those party to it, so not the Lugano Convention parties, Norway, Switzerland or Iceland. So something to look out for, but you can easily find a list of the relevant signatories online if you want to have a look. So the catch-22 of the Hague Convention is that it only applies to contracts that have an exclusive jurisdiction clause. So what does an exclusive jurisdiction clause mean, and does it matter? The short answer is yes, but I will explain a little bit as to why. So an exclusive jurisdiction clause is where, if there is a default, a claim can be brought in the jurisdiction specified in the contract or your finance agreement only, which means the lender and the borrower can only bring a claim in an English court if this is the chosen jurisdiction in the contract. They can't bring it in a French court or anywhere else. So why does this matter to us? It's quite significant in our sphere, because asymmetric jurisdiction clauses are really common in the financial sector. And what this means is that they typically require a borrower to bring proceedings in one place only, aka Scotland or England, while the financial institution may choose to bring proceedings in any jurisdiction they elect. So the reason lenders want this flexibility is so that they can raise the action in the jurisdiction or country in which the borrower group might have assets without having to analyse the whole situation and where all the borrower's assets are at the point of negotiating the contract. Lenders are generally, since this is in the lender's favour, this is generally accepted. So there's no certainty yet as to how these kind of asymmetric clauses will be treated by courts of EU countries. But for example, French courts take a very strict approach when compared to the UK and conclusively do not include asymmetric clauses as exclusive agreements. So unfortunately, a lot of European countries take a similarly strict view. For now, if you want to take advantage of the Hague Convention, the safest assumption is that only fully exclusive clauses which apply equally to both parties will be within the Hague Convention. So Claire's talking more about market practice later, but just to touch on, in the derivatives market, is that hedging agreements have published an amendment agreement enabling the insertion of an exclusive jurisdiction clause into their template agreements. And the Low Market Association that Claire mentioned earlier also have likewise added an optional two-way exclusive clause further to the Hague Convention for use where appropriate. So just to highlight that this is being noticed and is being considered at the moment. So the final but important note on the Hague is to pay attention to contracts concluded over the period while we remained in the EU under Hague. So I think I mentioned this was from October 2015 until obviously when Brexit happened at the end of 2020. So this is because the Hague Convention only applies where the jurisdiction agreement was agreed after entry into force of the Hague Convention. So the UK government has made it clear that they consider the relevant date for entry into force of the Hague to be 1st of October 2015. However, and really more importantly for our purposes, the European Commission have declared that they disagree. So an exclusive jurisdiction clause may need restated. We don't know how this is going to be decided in courts in EU member states yet, and ultimately the Court of Justice of the European Union will have to resolve this issue. But it is something that's being considered, so look out for updates. Just to touch on another option, arbitration is constantly being talked about and considered whether it is a better option for commercial contracts, but it is particularly attractive in the context of Brexit for enforcement of judgments. It is governed by the New York Convention on recognition and enforcement of arbitral awards, so it is largely unaffected by Brexit. So finally, from me, a quick comment on what is going to happen regarding the choice of English law as the governing law of contracts that I just touched on at the start. So the traditional choice of English law for finance contracts, it's always been a popular choice, probably for the reason that the starting point under English law is that party autonomy prevails. So English law will, for the most part, give effect to what parties have agreed, and there's also a high degree of legal certainty, and parties can know what to expect under English law. So it is this traditional choice of English law still an attractive option against the backdrop of Brexit. The choice of governing law of a contract will be upheld due to UK incorporating Rome Regulations 1 and 2 into domestic laws. You may or may not know about these regulations, but they contain provisions, among other things, requiring courts of EU member states in general to respect parties' contractual choice of law. As a result, a clause in a contract specifying that the laws of, for example, England and Wales shall govern a contract, and any dispute arising would generally be upheld by any EU member state court. Also, really, most courts recognise, again, the party's right to choose a law regardless of legislation, conventions, or anything else. It is classed as one of those areas that lawyers get very excited about, but everyone else less so. Just as a side note, English law is also overwhelmingly the choice of arbitration disputes, and as discussed, since it is governed by a New York Convention, Brexit is really quite unlikely to affect that. So this, I suppose, leaves us with the question of whether the effects are really more procedural problems and hurdles than anything else. But I am going to pass you back to Clare now, who's going to give you a rundown of what's been happening in the market since Brexit.
Thanks. So as we come to the end of our session this morning, I thought it'd be a good idea just to touch on a few trends which we are starting to see in the market post-Brexit, and I'm sure you will be seeing all, if not all, some of these. So the first trend is really a geographical one. We're seeing the shift of focus away from the UK and especially London to other European cities such as Frankfurt and Paris. And most of you will probably have noticed that a few weeks ago it was reported that Amsterdam had surpassed London in terms of the most active share trading centre. Another trend which we have started to see signs of and expect to see more of is increased interest in opportunities in Northern Ireland. Since for borrowers there's the easy UK-EU border there, opportunities open up for them, and lenders are starting to look to seize the advantages there for themselves as well in supporting those borrowers with their ambitions. Another trend which we are starting to see is a build-in of additional time for construction projects because of freedom of movement issues. So we've seen quite a few examples of transactions where there have been some delays because of this, whether that's down to problems with having, for example, engineers coming in from EU countries or for parts or machinery which are needed to come in. So for example, one of our lender clients had a transaction where there was a biomass plant, and it was important that it was commissioned by a certain time so as the RHI would be payable in terms with the company's projections. However, due to the movement issues, there was a delay in getting necessary personnel from Europe as well as parts, so the RHI payment wasn't able to be made till quite a few months later, which obviously impacted quite strongly on the projected cash flows of the project. In terms of other things that we've noticed, there is obviously the impact of trade barriers. That's something that's being discussed, but it's still to be seen exactly how that goes. There will be some winners and some losers. But one key thing which is obviously taking place and which we will all have drawn our attention to is the replacement of the European Investment Bank and how that will need to be replaced with some more domestic funding. And for a large part, private funders will come in there, but there is also a significant opportunity for the new Scottish National Investment Bank to take a leading role. So with their mission-led investment focus, tailored to deal with the grand challenges in which they have set out as the climate emergency, place-based opportunity, and demographic change, they are going to make quite a big impact on the Scottish investment scene. And of course, we also have the new UK Infrastructure Bank, which we recently found out will be based in Leeds, and that will have an initial capitalisation of £12 billion. And it too is aiming to play a key role in helping the country reach zero carbon targets, as well as pushing forward the UK's levelling, the UK government's levelling up agenda. But perhaps the most obvious key trend to note is the impact of Brexit on banks' existing or potential customers. Although there are challenges presented by Brexit, there are also many opportunities for customers to seize, and those customers have increased cash flow needs and need greater investment. So there's a real opportunity opening up for banks there as well as customers. I think partially motivated by Brexit, but also by COVID, and perhaps also by environmental and sustainability concerns. There's going to be a real drive for SMEs to provide services to ensure that local supply chains are possible. I think we've all been seeing the importance of having those local supply chains now after the upheaval of the recent months and years, whether it's due to Brexit or COVID or other things which we're seeing on a sort of global basis. So in terms of our overall impression, yeah, we think that Brexit will give wind to general financial dislocation, perhaps a bit of readjustment, but we think this will be a short-term and transitional impact. And once we all make a few adjustments, it will be back to business as usual without too much of a grand effect. But perhaps just now would be a good time to check in on the responses to the poll, which you all did earlier. And it'll be interesting to see how you have all seen the effect of Brexit so far. So I think you should be able to see those poll results on the screen now. Oh, so this is interesting. We've had quite a few responses here. Nobody has said that they have seen increased financial activity. I mean, I think it'd be fair to say that that chimes with our experience. Although in certain markets, I think there's certainly been an uptick in financial transactions, but overall, I wouldn't say we've seen an increase. So 35% of respondents have seen decreased financial activity. Perhaps some of those respondents are, for example, in the real estate market, or others which have been impacted heavily by the uncertainty over the last few months, whether that's sort of combination of COVID and Brexit, or just Brexit if there's some international supply chain issues perhaps. But the overwhelming majority here at 65% have seen no change to financial activity. And I think we can safely say that that's a positive thing for us all to take working in the industry. There's plenty of deals going on, there's plenty of opportunities. And yeah, perhaps these opportunities are shifting a bit, new ones are opening up, some are maybe closing off, but it's good to see that customers and companies are rising to the challenge, as are the lenders in helping them meet their objectives. So now we've come to the end of sort of formal presentation. If you want to put any more questions in the chat box, please feel free to do that. Otherwise, we'll have a look to see what's currently there and just take any questions that you may have.
Thanks, Claire. I've just been having a check. So we've got a question in, which is probably my bag. It's the question is, do we think the UK is going to diverge from the EU on financial services? I think certainly in the terms of how our rule book is composed, we're definitely going to see some changes, probably sooner rather than later. The Treasury is already consulting on a move away from the current legal structure that we've inherited from the EU. I think we're going to see a lot more rulebook focused rules. So the regulators, so what the areas that have got the real expertise, the FCA and the PRA, we're going to see a lot more sitting in rules rather than in Acts of Parliament. And I think that's a good thing, not only because the experts are making the rules, but also rules are easier to amend than acts of parliament, so we'll have a more agile form of regulation and we can respond to emerging risks much more swiftly. So I think that should be a good thing. I think also might help those who need to keep a handle on the rules in their everyday work. It should make it easier for them, which is a good thing. In terms of policy, there's obviously quite a few things that the UK government is going to be sort of balancing up. They're going to want the UK to be an attractive place for financial services firms to do business. We've got a tradition of being of having a good and high standard of regulation. I'm not convinced we'll become a forum of low regulation, but that remains to be seen. And then I mentioned equivalence, and it's, you know, at the moment our rulebook is pretty much identical to what's in the EU, and yet still we haven't been granted any meaningful equivalence determinations from the EU. So if we overhaul how our rulebook looks and possibly depart on policy too, you know, what effect is that, or impact is that going to have on the EU Commission's decisions around equivalence? So I think we're definitely going to see a natural drift. I think there probably will be some active divergence, but it's really an area to watch, I think. Just looking, got a question on, Kendall, I think it'll probably be you. It's on jurisdiction clauses. Are we seeing a move towards more to exclusive jurisdiction clauses and away from non-exclusive jurisdiction clauses?
Yeah, thanks. That probably links quite well onto what I was talking about. So to be honest, before Brexit, because we knew we could rely on Brussels, the issue of whether jurisdiction clauses were exclusive or not in our finance contracts never really came up, or they were never really negotiated. They were kind of just accepted because they were in the lender's favour. What we can say is there's definitely more thought going into this now. There does need to be more consideration of it, and I suppose people considering now maybe at the outset whether enforcement of a Scottish or English judgment might need to be enforced somewhere else in the EU. Because now if we do have a non-exclusive clause and someone took a case, the borrower took the case to the French courts, is not to say that the French courts won't now hear the case without Brussels. So basically, yes, we are seeing it. It's being discussed more, and we are obviously seeing options from our big organisations like ISDA and the LMA. So obviously it is a point of discussion, but I'd say not enough yet to say it was a trend. It's definitely something we're keeping an eye on though.
Thanks, Kendall. And quickly, I think the last one, Claire, going forward now, post-Brexit, are there any new UK laws that are on the horizon that will have an effect on finance transactions?
Yeah, I think post-Brexit, it's still to be seen exactly what will be in place, but I think it's safe to say that we can expect a variety of specific UK laws being brought in. So one, for example, which is on the horizon is the National Security and Investments Bill. I think I've got the title right there, something like that. But anyway, that will likely have quite an impact on leveraged acquisition financings, and also potentially on the granting of Scots law share pledges, which is relevant for a lot of transactions based in Scotland or where we have a Scottish entity. So without getting into the technicalities of that just now, if you're interested in knowing about that, feel free to drop me a note afterwards. But other than that, I think it's safe to say we can expect to see other new UK laws. So for example, that might be on things like GDPR and other things which have been dealt with by Europe before, but on which we need to take a UK specific approach. So yeah, it'll be an interesting few months, few years perhaps, watching this all play out. And yeah, again, as I was mentioning, the Loan Market Association, the LMA is really good to keep an eye on their updates, because they're always tracking these things and often publishing updates to their own LMA template loan documents, which takes account of different rules or regulations or new laws coming into place. So that's a good place to get a pointer as to how you might deal with those, or of course get in touch with us and we can guide you on that.
Thank you, Claire. I think time-wise, probably at that stage going to bring this session to a close. Thank you again to everyone who's joined us today. We've really hoped you've enjoyed the session. Thank you for your questions. If you've submitted one that we've not had a chance to get to, we'll follow up on that with you offline. If you'd like to hear an update on the UK government funding schemes, please join us for our next session. There'll be details on our website and invites will follow shortly. In the meantime, thanks very much again. Take care, stay safe, and goodbye.